Hi, and welcome everyone to Novi Wealth's third quarter market review. I'm Daniel Satz. I'm one of the wealth managers in the firm. And today with me, as always, is Mario Nardone, our chief investment consultant. Welcome, Mario.
Thanks, Daniel. Happy to be here. How are you?
I'm doing great. So today, we're going to be continuing to shed light on the changes in our economic landscape that have taken place over the last 3 months that have impacted the global markets and hopefully have a better understanding of what the implications are, but ultimately want to focus on those things that we can control by sticking with a structured plan and really using science to dictate our actions as opposed to emotions. So with that, Mario, why don't you get started?
Sure, will do. And totally agree on that we don't want to imply through these reviews that we need to be looking at such a short time period, but we do, need to be aware of what's happening in the market and environment just so we can better understand what's happening in our portfolios and ensure that we're all well positioned.
Absolutely.
So I do want to point out, it's not lost upon us the turmoil that has kicked up in the Middle East since the end of the quarter, certainly going to have some impacts from a humanitarian perspective, geopolitical, and economic perspective. And we have no way of predicting what's going to happen there. Our hearts certainly go out to anybody affected by war and violence. But for now, what we really want to do is pay attention to the facts and figures from the third quarter as they were as of September 30th. And at that time, and like in previous iterations of this quarterly review, we don't want to have too much of a rose tinted lens, nor do we want to be too, the sky is falling when we approach our investments. So we take a balanced approach. And on the left side of the page, you see some of the reasons for optimism. At the end of September, there was a lot of consternation about whether the government was going to shut down. Luckily, we were able to avert that. Also, on a positive note, those investors that have bonds in their portfolio or other income generating assets, they're now actually generating income. Yields were very low for a long time, and now we can expect a little bit better returns from that side of our account. And then here in the US, as far as the economy goes, the labor market remains strong. That is good for the consumer as well as for the business cycle. Now that ties into the first bullet on the right side of the page on the reasons for concern side. And that is that a tight labor market, doesn't give them the sensation that the economy is slowing down enough. And it's their goal to try to get inflation under wraps. So with a tight labor market, that could signal that the Fed is going to keep rates higher for longer, which will have a dampening effect on the economics of our country. Secondly, we have had a decent run for the stock market, but that has been narrowly focused on just a handful of stocks. We would rather see that be more broad-based, and we'll talk about that in the coming slides. And then in terms of our non-US investments, we see the dollar continue to strengthen, and that actually has had a downward pressure on the performance of our non-US investments. And that's not a small portion of our portfolio. So the dollar's strengthening has actually been a little bit of a headwind recently.
Yeah, and one thing I'd like to note is that people are still recovering from what we saw happen in the bond market over the past year and a half, because for the past 10, 15 years, fixed income, while it's provided volatility dampening the portfolio due to it being so stable, um, because of the extremely low interest rates, it was difficult for a high quality bond portfolio to provide meaningful income. So these interest rate hikes have been negatively impacting bond values in the short term, but it just want people to focus on the fact that in the long term, the increase in the income from bonds is really an essential aspect for conservative investors who prioritize that safety over high returns, because while continuing to provide that long-term stability, the income in the portfolio will now be noteworthy.
Absolutely. Yeah, 100%. We'll take the short-term decline for the long-term pickup in yields any
Yep.
day. All right, so I mentioned earlier about the government shutdown, and that talk sort of came and went, and people aren't really even talking about that anymore, but it'll probably come up again. So we thought we'd share the slide on your screen now that shows the historical return of the S&P 500 during past government shutdowns. And any of the brownish colored dots to the left of that center line indicates that during a shutdown, during that particular shutdown, the market was negative. And the green dots to the right indicate positive returns. And if you look all the way at the right, you see that during the 21 previous shutdowns since 1976, it's been sort of a coin toss. 11 positive return periods, 9 negatives, and 1 period when the market was closed. So in other words, we really don't want to get too concerned about government shutdown from an investment perspective. Now, I do want to point out that that is different than the debt ceiling debate. Back when there's a chance that the government was going to hit the debt ceiling without a resolution, that has the potential implications that government employees don't get paid, or importantly for investors, that the government defaults on their debt. So definitely two different news stories that have potentially different results or potential impacts.
Yeah, and that was an immediate observation that I had, is that the market reactions to government shutdowns have been pretty balanced. So suggesting that shutdowns can create uncertainty is true, but they don't consistently lead to negative market outcomes. But that being said, in instances when they do, the negative impacts have been pretty moderate, if you see there. And if you look at the most significant drops, which were during the late 70s, given the broader context of those times with high inflation and other macroeconomic challenges, it might even be an oversimplification to attribute those market declines solely to government shutdowns.
That's a great point. Yeah, you can never just assume that only one factor is happening at any one point in time. And it's difficult to control for all of those different environments because they're all too different.
Right.
So great point, Dan. All right, so you can't really look at the economic news or any news really these days without hearing about the Fed. So we're going to talk a little bit about that. So just to keep in mind, or as a refresher or educational piece, when you talk about the Fed increasing interest rates, the purpose of that is to slow down the economy because they feel inflation is getting out of control or has gotten out of control. But they also don't want to raise rates too much and end up tipping the economy into a recession. So what we're looking at here is the basically on the left side of the page, you see the path that the federal Fed funds rate has taken. That's the solid line. The solid line ends with where we are today. Then the dotted line represents where the market thinks the Fed is going to be as we proceed from now through the end of next year. Those little circles, one set in the middle of the page and one on the right, represent the predictions of each of the Federal Reserve members. So the folks that get to vote on where this federal funds rate ends up are represented by those dots. So let's look at the far right side of the page. And if you look at where those dots are spread out relative to where the dotted line is, this is telling us that the market is predicting that rates will come down faster than even the Fed collectively thinks they are going to be. Now, we don't really want to draw any predictions from this. But also, I think the one thing that's important here is to have a sense of scale on this graph. If you look, this graph doesn't start at 0 on the left side of your page. It starts at 4. So even if we think at the end of December of 24, if the market's right, we're still going to be back to where the Fed funds rate was back in December of 22 at around 4.5% or so. So we have a long way to go to get back to those really accommodative interest rates. And we just really kind of need to keep that in mind, that there is a good likelihood that the Fed funds rate will remain elevated for an extended period of time, unless we have some sort of a catalyst, or as economists would say, an accident that would require further action by the Fed. Another graph showing the historical Fed funds rate. This time it goes back further on the left side of the page, and this graph goes all the way to 0. So what this shows you is the path that the Fed funds rate has taken since the dot-com bubble burst. And what they're really trying to show with this slide is that if you look at how the rate increases, it looks like a set of steps, but how it decreases is typically like an elevator. So if you think about the previous slide, the market and the Fed is sort of looking at this from where we sit today and saying, okay, maybe we can expect a gradual decline. But if history is a guide, there has been more instances where they've had to decrease rates a lot faster than that because there have been some kind of an economic transition or inflection point that required them to be more stimulative and less gradual. Federal Reserve controls the short-term part of the yield curve, cash yields and things like that. So right now it's enticing to stay in cash. You're getting 5%. Why should you take risk of being in a bond fund, for instance? Well, what you're looking at here is the path that the 10-year Treasury yield has taken over the last 15 years or so. And the way you draw the connect to what we were just talking about is if you look at the far right side of the page, you see that the 10-year Treasury yield is now approaching 5% again. Now, that means that if you buy a 5-year Treasury or 10-year Treasury today, you're going to get close to 5% for your, if you hold it to maturity, you're going to get 5% that whole time. Versus if interest rates come down that elevator and you were holding too much cash, well, now your 5% yield on cash, maybe 3%, maybe 2%, maybe zero. And you would have missed that opportunity to lock in those 5% yields for 10 years had you extended your portfolio and stayed invested in the bond portfolio. And as Dan mentioned, there's other benefits of doing that. For example, if the stock market comes down, long-term bonds have the opportunity to increase in a flight to safety. Cash doesn't really have an opportunity to increase. Yes, it'll stay stable, barring some other unforeseen circumstance, but you're not going to get that negative correlation that we count on from our bond assets. Now, I want to point out on this slide that there are a lot of functions, a lot of reasons that the 10-year Treasury yield has moved higher, as you see it's done on the right side of the page over the last couple of years. And like we said earlier, if you read the news, a lot of folks try to just tell you this is the one reason. It's because the Fed said rates are going to stay higher for longer or some other, prognostication. But the truth is there's a lot of factors that are baked into that. One is that the Fed is also unwinding its balance sheet. The Fed has been a big buyer of treasuries. They're not doing that anymore. The Bank of Japan and other countries around the world have also historically been big buyers of U.S. Treasury bonds. They're not at the table anymore. And when you don't have those buyers, you have bond prices that are lower. And if you remember simple bond math, when yields go up, prices go lower and vice versa. So there's all kinds of reasons that are baked into this, and you don't want to get hung up on any one thing and try to make a prediction or make a portfolio change based on any one factor.
One thing that's interesting, and I don't know if the audience is looking at this chart like I am, but I remember buying my first house back in 2007, toward the end of 2007, beginning of 2008, and the mortgage rates were 5%, if I remember correctly, or 4.75%. And looking at this chart, you could see that, the 10-year Treasury, which at the time, when I was buying my first house, my mortgage broker kept looking to the 10-year Treasury, and that was what was impacting, the rates for when I should lock in. And it's interesting because people might be looking at this and saying, well, why are mortgage rates 8% today almost when the 10-year Treasury was even higher? The rates were something along the lines of 4.75% or 5%. Just to want to clarify that part of the reason could be, there's many factors involved, but one could be that lenders have become more cautious after the 2008 financial crisis and might be demanding a higher risk premium due to concerns about borrower defaults. But like I said, there's many other factors that dictate the interest rate on mortgages, such as liquidity concerns in the market and supply and demand dynamics, and even global economic factors. But I just want to point out the good news is that as inflationary pressure starts to ease, there might also be downward pressure on both the 10-year Treasury yield as well as mortgage rates. and people who have purchased homes recently will have an opportunity to then refinance at a lower rate.
That's great color, and that's certainly something that is relevant to our, even though it's not, about portfolios. I think that's great, and it illustrates all the various implications of investment markets on our financial plans and our overall household economics. So I appreciate you bringing that up. So as we turn to the bar charts here that show the performance of the bond market, we think about that concept that as bond yields go up, prices fall, and vice versa. So if we already know that yields went up recently, it's no surprise that on the left side of the page, you see negative returns for the third quarter for most types of bonds. Shorter term bonds held up a little bit better, but in general, the bond market had declined. And over longer term periods, to the middle and right side of the page, you see more mixed reviews. Now, not to belabor the topic of bond investing or fixed income markets, but one of the reasons why short-term bonds held up better is because their yields didn't move as much as the 10-year and longer-term bond yields moved. So this graph is a great way to illustrate that. So if you look at the difference between the greenish line there and the dark blue line, and you see that the difference between those two is wider towards the right side of the page, that's an indication that longer term bonds moved up more so than short term bonds. And once again, to really drill this point home, as those yields climbed, their prices fell. So longer term bonds are expected to underperform during that period or during times like that. Turning away from stocks or bonds and turning towards stocks, we see their performance on the left side of the page for the quarter. And you see that almost all size and style categories, so large, medium, small size companies, and in terms of style, value, and growth, they all were pretty much down 3% with one exception. And that is the small cap growth category, which you see in green there, that had a negative 7.3%. Luckily for us, that's the part of the stock market that we have the least exposure to, so we can take a little solace in that. However, the big story is more so in the year-to-date and last 12-month columns, where you see those towering gray bars that represent large cap growth stocks, large company growth stocks, lots of tech stocks in there. We're going to talk about them in a second, but they've really dominated the headlines and dominated performance within the US stock market recently. And the reason for that, as I mentioned, it's really the large cap tech stocks that have driven that return. This slide drills down into that even deeper. What you're seeing here is a breakout of the S&P 500 to take the top 7 stocks, and they're calling it the S&P 7. That's not a real index, but the people who put the chart together created the S&P 7 and the S&P 493 to represent the rest of the 500 stocks in that index. The green bar here, green line, shows you the performance of the S&P 7 so far this year. And you see that it's up over 50%. And at one point, it was up about 65%. But if you look at the S&P 493, it's effectively flat. So if any allocation that you have had in your portfolio away from those top 7 stocks would have actually been a detriment. Now, if we think about the concepts of diversification, we certainly don't think that a 7 stock portfolio is diversified or anything that we ever want to consider as a portfolio strategy. Not to mention the fact that it's impossible to know in advance which 7 stocks you're supposed to own. So yes, it's an anomaly in the market. Yes, it's causing some questions about account performance, but it's not something that we ever would have predicted, and it's not something that we're overly concerned about. And the reason we're not overly concerned about is if you look at the third paragraph on the left, what you see, what that's trying to tell you is that those 7 stocks now constitute about a third of the index, which has 500 companies. That means their valuations have gone through the roof. And that PE ratio that paragraph indicates, the price to earning ratio of around 50, means that if you were to buy those stocks today, you'd be buying $1 of earnings, of future earnings, for $50. And the average PE for the market historically is closer to something like $18 to $20. So yes, these stocks have done well, but no, we would not try to go and chase that or think that that trend is going to continue. So if we look at the market a little bit differently, some research recently uncovered the fact that if you control for everything else, more profitable companies outperformed less profitable companies. Now, this is actually a whole separate conversation from what we just talked about with the top 7 stocks. But when I say more profitable companies did better, that may sound somewhat elementary or obvious, but when you think about all the other factors that go into why people buy and sell stocks, it really doesn't always work out that way, that more profitable companies do better. Now, over the long run, it is generally the case. And that is why within our strategy, we do prefer to have investments that pay attention to profitability. Yes, we might lean towards a value-oriented approach. Yes, we might have a little bit of a tilt towards smaller companies, but behind the scenes, we also employ vehicles, mutual funds, ETFs, and what have you, that try to focus on this profitability factor as well. And we just wanted to call that to our attention because some of the strategies that we use are actually doing better than broad indices that generally track their style of investing. So we already looked at US bonds, US stocks, and now let's talk about international stocks. So if you look at the left side of the page, we actually see mixed results in magnitude, but mostly negative returns from non-US stocks. So that's companies in developed economies like Germany and Canada, large and small, and then also emerging markets like China, Brazil, and India. So on the right side of the page, the middle and the right side of the page, you see that these longer term results for non-US stocks were positive, even after, as I mentioned before, even after the returns were muted by a strengthening dollar. And maybe it's worth explaining that the reason why a strengthening dollar puts downward pressure on our returns is because you have to sort of imagine that as a dollar-based investor, in order to own a German company, we have to basically sell our dollars, buy euros, and then buy the stock in euros. So we don't hold our dollars during that period. So if the dollar strengthens, then at the end of the period, we're hypothetically trading in euros back for dollars, and we have to buy them at a now higher price. So that's the dynamic of why stronger dollar hurts international stock returns.
If you look at this chart and then if we think back to the chart where we were looking at the US stock returns and the global bond returns, they all pretty much tell the same story, that there was this recovery over the last 12 months coming off of the market that we saw last year. And year to date, for the most part, were positive. But if you look at this quarter, you'll notice that they're all negative, with the exception of a couple of small asset classes there. But I'm looking right now at the international large cap growth, which was the worst performing asset class in the third quarter, but it performed better than 4 of the 8 asset classes over the past 12 months. So this is just to emphasize that, we don't want people to think that you should be making changes to your portfolio based on what's happening in the short term. And that also applies broadly to equities in general. The short term doesn't tell the whole story. It's the longer term that is really going to dictate, performance.
Absolutely. We think that over a market cycle, it's hard to really define exactly what a market cycle is, but certainly nothing less than a 3-year period is what we consider to be meaningful from an investment performance perspective. But also the historical numbers shouldn't be what you're basing your investments on either, right? We want to look forward and invest according to what's going to satisfy the financial plan.
Sure.
So just to put some solidity behind the dollar conversation, what we have here is the two graphs. The bottom one shows the path that the US dollar took versus foreign currencies in the quarter. So at the left side, you have the beginning of July, and you see a steady trend upward through the beginning of the fourth quarter, but essentially it's the third quarter as a whole. So that's where you see what I mentioned earlier about the increasing strength of the dollar, putting downward pressure on foreign holdings. But to your point, Dan, taking a longer term view, the right side, the top of the page is a multi-decade trend line of the dollar versus foreign currencies. So going back to 2000, you see the dollar steadily declining in value for about a decade, maybe a little bit more. And if you remember, that's the decade that was known as the lost decade of US stock market returns. And so during that period, where you got almost no return from US stocks for 10 years, if you had diversified into international stocks, that declining dollar essentially would have saved the day, and your portfolio actually did quite well. Now, since that inflection point, somewhere around 2011 or 2012, the dollar has strengthened. And that's partially why people often question whether we should be invested in international stocks at all. The companies themselves could be doing quite well. Even if their economy is not doing well, companies can still make money. We can't forget that companies like Nestle might be based overseas, but they're selling their goods in the US and in China and everywhere else. So we have to remember that the dollar headwind could give those investments a bad look, even if we know we should be diversified, and even if they actually turn out to be good investment. And just to sort of talk about this concentration effect again, the whole idea that only a handful of stocks really drove performance here in the US. This graph does it a little bit differently. It looks at the largest 15 stocks and what their total return was year to date through close to middle of September, close to the end of the third quarter. So you see the US largest 15 stocks were up 41%. The S&P 500 as a whole was up 17%. That disparity did not exist in Europe, which is represented by the Stoxx 600, nor did it exist on the Tokyo Exchange, which is shown at the far right. So that was definitely a US only phenomenon.
Yeah, that's roughly what happened during the recovery after the market dip in March of 2020, where the S&P 500 going forward was carried by the big tech stocks, the FANG stocks, Facebook, Amazon, Apple, Netflix, and Google. But then shortly after that, the tech sector took a major hit. And I assume, in that previous slide, when you were talking about the S&P 7, that some of those were in there as they recovered once again. But this is why global diversification is such an important element in a well-diversified portfolio, because a market dominated by just a few stocks might be more vulnerable to specific sector headwinds. So, making sure you don't over-concentrate into any given area of the market may result in better risk diversification.
Yeah, 100%. You couldn't be more right. We definitely don't want to chase that performance, but also, our style of investing makes sure that, yes, we have exposure to it, but we don't get overly exposed. That, we keep buying more as their price goes up. But instead, we want to diversify by, rebalancing out of that category, taking profits where we can, and redeploying into categories that are out of favor. Because invariably, no single company can continue to grow at that pace forever. Otherwise, they become the market, right? So at some point, either the rest of the market catches up, or that price turns out to have been a bubble and it comes back down to earth. So one final topic to cover. We've gotten, I don't know about you, Daniel, but we've gotten a lot of questions about China. There's been a lot of concern over the increasing authoritarianism of the government. Obviously, it's having some economic problems, the commercial real estate debacle over there. So folks are asking about, should we divest from China? Um, our response to that is China is, 1/3 of emerging markets. It's about 3% of the global stock market. It's the second largest economy in the world. And yes, it's going through some trouble, but we believe that most of that trouble, to the extent that it's observable, it's already priced in. The risk is already priced into Chinese stock prices. So unless we know something that the market doesn't already know, and we think that they haven't effectively priced in those risks, we believe that it's already in there. So if those risks turn out to have been overblown, in the reverse of what we just talked about with large tech stocks, we don't want to be out of those stocks because of excess concern. And so we believe that we're going to, continue to invest in China. One good thing is that the funds that we use don't invest for the most part in mainland Chinese stock exchanges. They invest in Chinese companies that trade, for instance, on the Hong Kong exchange. So we can answer any questions that individual clients might have about their concerns about China, but that's our overarching view. The slide you're looking at here shows you that most of the time, emerging markets returns and China stock return are pretty much hand in hand. But at the far right side of the page, you do see that some of those concerns with China have depressed their stock prices below that of emerging markets as a whole. And that reflects that pricing in of that risk that I was talking about earlier.
Yeah, and I wouldn't say we've had a whole lot of questions regarding this, but I mean, it is such a big portion of emerging markets, like you said. So if we eliminate exposure, yeah, maybe that looks good in the short term, or maybe not. But to reiterate what you just said about the size of their economy, I don't think it would be prudent in the long term to completely avoid exposure.
So with that being said, Daniel, you early in the call, you talked about focusing on things you can control. And that's what this page is about. It's about the holistic view of financial planning, looking at all your goals, looking at your resources, looking at your risk tolerance, and positioning appropriately. I'm here to make sure that we're looking at investments and the economy so that they could support that plan. But the work that you do, the work that Novi and the rest of the team does, really is more broad based than that. And I think some of those concepts are listed here on that page. I think they're super important. They're definitely in the driver's seat with investments as a co-pilot of sorts. So I'll turn it back over to you to close this out, unless you had any other additional questions for me.
No, I think you're spot on. And we know we have to track what's going on in the global economy. So we understand what our investments are doing for us and how they're being impacted. But ultimately, it's best to focus on our long-term goals and objectives and understand that the markets are going to do what they're going to do. And, since we don't have a crystal ball, we have to stick to a structured plan and have discipline regardless of how we're feeling because of what we see in the headlines or because of what the indices might be doing on a given day. So it's a great presentation, Mary. I want to thank you, as always, for keeping us informed and helping keep us and our audience grounded.
Thanks, Daniel. Happy to do it and standing by for any follow-ups.
All right. Well, thank you very much, Mario, and we will talk soon.
Sounds good.
All right. Have a great day.
You too.
All right.